Today is Friday, August 7th, and this morning, the entire financial world has its eyes on one number. The July Nonfarm Payrolls report drops at 8:30 a.m. Eastern Time, and every serious investor in precious metals needs to understand what this number means before the markets open, because the move it triggers could be the most important one-day move in gold and silver since June. Gold is trading near $4,260. Silver is holding around $62.45. The gold-silver ratio sits at approximately 68-1, and every one of those numbers is about to be tested by the data coming out in a matter of hours. Here is what makes this Friday different from any other Payrolls Friday this year. ADP, one of the largest private payroll processors in the country, showed just 44,000 private sector jobs added in July. That is the smallest monthly gain since January, less than half of June's already weak reading, and well below the 75,000 Wall Street expected. That number hit Wednesday and quietly shifted the entire conversation. Wall Street is now expecting the official July non-farm payrolls report to come in at just 83,000 jobs, with the unemployment rate holding at 4.2%. But here is the part almost nobody is framing correctly. There are two completely different stories happening in this market simultaneously right now. Gold is watching the jobs number. Silver is sending its own signal, a signal that is not about jobs, not about the Fed, and not about oil. And by the end of this video, you are going to understand both stories clearly enough to read whatever happens next without panic and without guessing. Before we go any deeper, drop your answer in the comments right now. One question: what do you think the July jobs number delivers this morning? Strong, weak, or right in line? Your answer determines everything that happens to gold and silver before close today. Put your call in the comments. I read every reply. And if this kind of real-time breakdown is what you came for, subscribe. Hit the like button. This channel exists to give you the framework, not the hype. Let's go. Part 1. The chain. How today's number moves gold. Let's build the foundation first, because if you understand the mechanism behind today's data, you will never need to guess what a jobs number means for gold again. This report lands roughly a week after the Federal Reserve's July 29th decision to hold its policy rate at 3.50% to 3.75%, a decision that carried a three-way dissent from regional Fed presidents Hammack, Kashkari, and Logan, all of whom preferred a 25 basis point hike instead. 3 dissenting votes on the Federal Reserve is not a procedural footnote, it is a warning signal. Those 3 officials have publicly staked their position that inflation has not been tamed sufficiently and that the economy is strong enough to absorb a rate increase. If the jobs report this morning confirms their view, if the number comes in strong, say above 150,000, their argument gets materially harder to dismiss before the September 15th to 16th FOMC meeting. Rate hike odds, which are currently sitting at roughly 44 to 59% depending on the measure, climb. The dollar strengthens, treasury yields rise, and gold faces renewed downward pressure back toward the $4,000 support zone. If the jobs number comes in soft, consistent with ADP's weak Wednesday signal, say 80,000 or below, the September hike becomes significantly harder to justify. Rate hike odds fall, the dollar softens, and the chain that has been suppressing gold since its January all-time high starts to release pressure. Goldman Sachs pointed out that in recent years, July non-farm payrolls have often come in below expectations, accompanied by sharp downward revisions to prior readings. Wells Fargo believes that simultaneous slowdowns in labor demand and supply are keeping the unemployment rate temporarily stable, while Deutsche Bank stated that as long as the labor market does not deteriorate significantly, the Fed can still focus its policy on inflation. According to the Financial Times, individuals close to new Federal Reserve Chair Kevin Warsh stated that Warsh has admitted to those around him that there were indeed missteps during his first 10 weeks at the helm. He acknowledged failing to effectively reinforce the core message of maintaining price stability and allowing confusion to arise regarding whether his long-term Fed reform plans would influence short-term decision-making. That last detail matters more than it might seem. A Fed chair who privately acknowledges missteps in communication is a chair who is already operating with more uncertainty than markets initially assumed. And when uncertainty enters the Fed picture, gold historically does not go down. It waits and then moves. So the chain is this. Soft jobs number leads to lower rate hike odds, leads to weaker dollar, leads to gold moves higher. Strong jobs number leads to higher hike odds, leads to stronger dollar, leads to gold faces pressure. The mechanism is not complicated. The key is knowing the chain and knowing which way it is running before the headlines are written. Now here's the thing. Most of the commentary you will read today will be focused exclusively on gold and what the jobs number means for the rate path, and that analysis is correct as far as it goes. But it is only half the story, because silver is doing something right now that gold is not, something that is telling a completely different story, and that story does not wait for payrolls data to unfold. Part 2. Silver's signal, the part nobody is covering today. Silver at $62.45 is sitting near its highest level in about a month, and on the surface, that might look like silver simply following gold higher on rate expectations. But look more carefully, and the picture is more interesting than that. The gold-silver ratio, the number of ounces of silver required to purchase 1 ounce of gold, is currently sitting at approximately 68 to 1. 3 weeks ago, it was closer to 70. That compression is a specific signal that experienced precious metals investors watch very carefully, because ratio compression, silver getting more expensive relative to gold, typically signals one of two things. Either silver is catching up after a period of underperformance, or silver is beginning to lead the market higher, which is a much more bullish development for the overall metals complex. Here's the context that makes this compression more significant than a routine chart move. Despite solar panel manufacturers reducing silver consumption by 19% in 2026, the global silver market is heading for its 6th consecutive annual supply deficit of 46.3 million ounces, wider than the year before. The deficit is expanding because mine supply is contracting faster than industrial demand is falling. Read that carefully. Solar manufacturers are using less silver per panel. That is a real headwind, but the overall deficit is getting wider anyway because the supply side is shrinking faster than demand is. The roughly 36 million ounces leaving solar this year are not disappearing from the economy. 3 structurally growing demand pools are partially replacing them: electric vehicles, AI data center infrastructure, and battery management systems. Battery electric vehicles use approximately 25 to 50 grams of silver per vehicle, 67 to 79% more than an internal combustion engine vehicle, according to the Silver Institute and Oxford Economics. At 15 million EV units projected globally in 2026, automotive silver demand from this segment is structural, not cyclical. Silver industrial demand entered 2026 on track to exceed 720 million ounces for the year, the highest figure in Silver Institute records. Industrial applications now account for roughly 60% of total silver consumption, up from 50% a decade ago. The cumulative deficit from 2021 to 2026, approximately 1,050 to 1,100 million ounces. This is more than a full year of mine production, drawn from above-ground stocks in LBMA vaults, COMEX warehouses, and various other inventories. More than a full year of mine output has been drawn from above-ground reserves over the past 6 years to cover the gap between what the market produces and what the world consumes. And those inventories are not being replenished. Inventories in warehouses linked to the Shanghai Futures Exchange recently hit their lowest level since 2015, while lease rates in London have remained elevated, both classic indicators of a shortage of readily available physical metal. So when you look at silver sitting at $62 today and ask why it is at 50% below its all-time high, when the structural picture is this tight, the honest answer is because the same macro force that has been suppressing gold, elevated rate hike expectations, dollar strength, has also been sitting on silver. That suppression is rate sensitive. It can lift quickly when the macro picture shifts. But here is the key distinction between gold and silver right now. When the macro suppression on gold lifts, when rate hike odds fall and the dollar weakens, gold's primary driver is monetary. Silver's primary driver, for 60% of its demand, has nothing to do with rates or the dollar or the Fed at all. It is industrial. It is structural. It runs on technology adoption curves and manufacturing schedules, and it does not care what Kevin Warsh said in his last press conference. That is why the gold-silver ratio compressing right now, silver beginning to outperform gold on a relative basis, is not just a technical chart observation. It is a signal that the industrial floor under silver is beginning to assert itself into the price, even while the monetary ceiling is still in place from the macro environment. Part 3. The full picture. What matters more than today's headline? Let's zoom out and look at the full picture, because the payrolls number in a few hours is important, but it is one data point inside a story that is considerably larger. Gold at $4,260 is sitting approximately 24% below its all-time high of $5,598 set in January. Silver at $62.45 is sitting approximately 49% below its all-time high of $121.67. Both corrections were driven by the same mechanism. The US-Iran conflict pushed oil sharply higher, which fed into inflation fears, which drove Fed rate hike expectations, which strengthened the dollar, which suppressed both metals. That mechanism is now facing headwinds from multiple directions simultaneously. ADP's weak July reading of just 44,000 private jobs, the smallest monthly gain since January, has brought the probability of a September rate hike down toward 44.5%, according to current market pricing. That is meaningfully lower than the 67% that was being priced just days ago. The direction of travel, before today's official number, is already moving toward a softer labor market picture. There has been a reprieve in oil from hopes for a Hormuz deal, but watch the wage numbers closely today, as even a 0.1 percentage point beat on the monthly wage number could tip the FOMC balance. This is the live market condition. The Strait of Hormuz tension, the geography that started this entire chain when military strikes began in late February, is showing signs of diplomatic movement. Every week that oil prices ease, the inflation fear that has been feeding rate hike expectations softens by another degree, and every degree of softening in rate hike odds is a direct release of the mechanical pressure that has been sitting on gold and silver since January. Now let's talk about what the institutions that manage billions of dollars are actually saying about where this goes. JP Morgan has set a year-end 2026 gold target of $6,000 per ounce. Goldman Sachs is at $5,400. Deutsche Bank at $4,600. State Street's base case runs between $4,700 and $5,500. JP Morgan projects silver could average $81 per ounce in 2026. Every single one of those institutional forecasts sits meaningfully above where gold and silver are trading right now. These are not smaller research firms. These are the institutions with the deepest research budgets and the most to lose if their analysis is wrong. The gap between current prices and institutional year-end targets exists because of one thing: the temporary suppression from the rate hike fear that the Iran conflict created. The structural case that those institutions are forecasting against has not changed. The fiscal deficits are not smaller. The debt is not shrinking. Central bank buying is not slowing. And silver's structural supply deficit is not closing. In fact, it is widening. The only thing standing between current prices and those institutional targets is time and a macro pivot on rates. Part 4. The 3 scenarios for the rest of today and beyond. Let's be specific. Here are the 3 paths today could take, and what each one means for gold and silver. Scenario 1. The jobs number comes in soft. If July non-farm payrolls print at 80,000 or below, consistent with ADP's weak signal, September rate hike odds fall sharply. The dollar softens. Gold breaks above the $4,312 to $4,319 technical resistance that analysts at Forex.com have identified as the key weekly breakout level. If gold clears that on a weekly closing basis, the technical structure shifts from bearish to constructive. Silver, with ratio compression already underway, is likely to outperform gold's percentage gain on any rally because industrial demand creates a second floor under silver's price that gold simply does not have. Scenario 2. The jobs number comes in strong. If payrolls surprise to the upside, above 150,000, rate hike odds climb back towards 60 to 65%. 3 Fed dissenters who wanted to hike in July get fresh ammunition. Gold faces renewed pressure toward the $4,000 support level. Silver pulls back harder than gold because silver's higher volatility in both directions is well documented. In this scenario, the central bank buying floor for gold remains intact. Central banks have been buying at a rate of 244 net tons per quarter and did not reduce their pace during the January correction. A dip toward $4,000 in Scenario 2 is not a structural breakdown. It is the suppression continuing for another few weeks, with the same structural case waiting underneath it. Scenario 3. the number lands in line. Consensus is approximately 80,000 to 85,000 jobs. If the print is right in that range, the reaction is likely muted in the immediate session. Rate hike odds stay near current levels. Gold holds its range, silver holds its range, and the next major catalyst becomes the July CPI report due August 12th, which is the data point that will carry the most weight heading into the September 15th to 16th FOMC meeting. July CPI lands August 12th, and July PPI follows August 13th. The two inflation reports markets will weigh most heavily ahead of the September meeting. FOMC minutes from the July meeting publish August 19th, detailing how the committee discussed the three-way dissent. In scenario 3, the week ahead, not today, becomes the most important data window of the month. Here is the thing worth sitting with. Whether today's jobs number is soft, strong, or in line, the structural story behind both gold and silver does not change with a single data point. What changes is the speed of the recovery, not the destination. The investors who understand that distinction are the ones who watch today's number with clarity instead of anxiety. And that clarity is exactly what the rest of this breakdown is designed to give you. Part 5. What silver is actually telling you that gold can't. Let's talk about something that is genuinely important and almost never gets explained correctly in precious metals coverage. Most people think about silver the way they think about gold, a monetary metal, something you own because you don't trust central banks or fiat currency. And that is accurate for roughly 40% of silver's demand. The other 60% of silver demand has nothing to do with monetary fear. It comes from manufacturing. Silver is the most electrically conductive element on the periodic table. Not one of the most. That single physical fact is driving one of the most significant demand shifts in the metals market today. Every solar panel, every electric vehicle battery management system, every AI data center's power infrastructure, every 5G semiconductor chip, they all use silver. And the critical detail that most casual silver commentary completely misses is this. China tightens silver export licenses beginning in January 2026, squeezing global physical supply further and reinforcing scarcity. China is the world's largest silver consumer. When the country that consumes the most silver also restricts how much physically leaves its borders, the available supply for the rest of the world tightens. That is not a forecasted development. That is a policy that went into effect this year and has been working its way through global silver inventory levels for months. The Silver Institute noted in its most recent report that the market has clearly entered an era of reduced stocks. Tightness will not be constant, but liquidity will generally be thinner, lease rates more volatile, and price moves likely to be larger than investors have historically expected. That last phrase is worth underlining. Price moves likely to be larger than historically expected. The Silver Institute, which is not in the business of hype, is describing a market where the structural tension between constrained supply and growing demand is building the conditions for price moves that overshoot what normal models would project. What does that mean for today's Friday alert? It means that when the macro suppression on silver eventually lifts, when rate hike fears cool, when the dollar softens, when the chain that has been running against precious metals since January starts running the other way, silver's move is likely to be proportionally larger than gold's. Because silver carries two engines of demand, not one, and right now both of those engines are running, even as the near-term macro pressure is holding the price down. The gold-silver ratio at 68-1 is not random noise. It is the market acknowledging that silver's monetary sensitivity is currently being priced in, while silver's industrial floor is not yet fully reflected in the price. When those two dimensions of silver's demand get priced simultaneously, as they historically do when the macro environment turns, the ratio compresses sharply, and silver's percentage move outpaces gold's. Let me close with the three things that matter most for the rest of today and the week ahead. Number 1. The payrolls print at 8:30 a.m. Eastern. Watch the headline number versus the 80,000 to 83,000 expectation. Watch the wage growth number. A surprise on wages is potentially more important to the Fed's thinking than the headline job count. Even a 0.1 percentage point beat on the monthly wage number could tip the FOMC balance. And watch whether previous months get revised down again. June's print was already revised lower, and Goldman Sachs has noted that July payrolls historically come in below expectations with downward revisions to prior months. Number 2. The gold-silver ratio. If today's number is soft and metals rally, watch whether the ratio compresses further below 68 or holds steady. A ratio compression towards 65 in today's session would signal that silver's industrial bid is beginning to actively compete with the monetary bid. That is a qualitatively different kind of silver move from what we have been seeing. Number 3. The $4,312 to $4,319 weekly close level in gold. This is the 52-week moving average and the 2026 yearly open, identified by analysts at Forex.com as the key breakout trigger. Gold does not need to close there today. This is a weekly level. But the direction it takes in response to today's payrolls print will determine whether a push toward that level happens this week or gets deferred to after the CPI release on August 12th. Here is the honest summary of where we are. Gold and silver have been held down since January by a specific, identifiable, and mechanical force. That force, rate hike expectations, generated by oil-driven inflation fears connected to the Strait of Hormuz conflict, is showing early signs of reversal. The ADP number Wednesday moved in that direction. Diplomatic signals around Hormuz have moved in that direction. And today's jobs report is the next data point that either accelerates that reversal or delays it. Silver has an additional story running underneath the macro picture. A 6th consecutive year of structural supply deficit, shrinking inventories in Shanghai and London, China's export license restrictions, EV demand replacing some of the solar slowdown, and the most electrically conductive element in the periodic table embedded in every technology sector that is growing right now. Both stories are real. Both have structural depth behind them. And this Friday, August 7th, 2026, is one of the clearest windows we have had all summer to understand exactly which direction the dominoes are about to fall. Whatever the number says this morning, you now understand the mechanism. And the mechanism is the only thing that matters. Thank you for watching. Subscribe if you're not already with us. Drop your payrolls call in the comments, and after the number drops, come back and tell me how you read it. The comment section is where this community does its best analysis. We will see you in the next one.